In this video, I will be discussing differences between IFRS and US GAAP reporting standards that relate to financial statement presentation. So right from the start, IFRS and US GAAP cannot agree on how to present the financial statements, let alone on how to calculate the numbers that go into them. I'd like to start with showing you an example so you can see for yourselves. Example 11-4A is available in the Excel spreadsheet provided on WebCourses. This example provides the income statements for two companies in the same industry, one who uses IFRS and one who uses US GAAP. Please pause the video and take a few minutes to review the example. Discussion questions are provided below the financial statements. When you have jotted down your answers to those questions, please restart the video. So I've opened up our Excel file and I'm on the first tab, which is E11-4A. So in this example, we have two income statements sitting right next to each other so that we can compare them more easily. And on the left, we have Air France KLM Group, whose consolidated balance sheet is using IFRS. On the right, we have American Airlines Group, which is their consolidated balance sheet is using US GAAP. And so when you pulled this up, hopefully you took a minute to peruse it before restarting the video. The first thing you probably noticed is looking at Air France, where's cash, right? So you're looking at the top here and you're expecting to see cash. And instead, you see goodwill. And that doesn't feel right. So if you start looking for cash, you find cash all the way down here as their last asset. Whereas normally, if we go over to American Airlines, which is using US GAAP, we find cash as the top. We start with cash. We expect that to be the first thing we see on our balance sheet. And so what you probably then started thinking is, okay, well, how'd they decide this, right? It's not just random, right? Cash is either first or last. And then over here we have goodwill at the top of Air France's, but goodwill is pretty close to the bottom of American Airlines. So what you'll find is under US GAAP, we show our assets in terms of decreasing liquidity. So cash is the most liquid thing there is, right? But goodwill, which is an intangible asset, how do you convert that into cash? That's going to be super difficult. So that is the least liquid of the accounts. So both IFRS and US GAAP agree that we should use liquidity, that that's an important measurement tool to decide how we order these things. They just disagree on which one should go on top. Now, honestly, it seems to me that this should have been one of the things we could agree upon, but for some reason, this has been a sticking point. All right. So then, when you started perusing the other side of our balance sheet, our liabilities and equity, you might have had a similar feeling. Again, it's backwards. So we have capital at the top here. And so just to make sure we're all on the same page, issued capital, same thing as common stock. So we have issued capital at the top here. We have common stock down on the bottom of our balance sheet for the US GAAP side. So again, it's not that we disagree about how we order these things. They've just done it backwards. So everything is the opposite of what we expect. We have current liabilities on the top. Their current liabilities are down at the bottom over here. Non-current liabilities, then stockholders' equity, stockholder equity. So we've just kind of flipped everything upside down and a little bit backwards, including liabilities and equity, right? We expect liabilities to be first. Nope, they showed equity first. So again, just if you looked at these questions, the first one was talking about our cash to goodwill, that order of liquidity. And then some other differences you might have noticed was that our equity and liability side was also backwards, that equity was listed before liabilities, and that they call their common stock capital. Same thing, same idea, just a slightly different name.
This slide and the next list differences between IFRS and US GAAP regarding financial statement presentation. Some of these we discussed during the previous example, but I will run through them all quickly. The first difference is which periods a company is required to present on the face of the financial statements. US GAAP requires 2 years for the balance sheet and 3 years for the other statements. IFRS requires 2 years for all statements. Next is the difference in balance sheet presentation. US GAAP provides the option to classify as current or non-current any states that This slide and the next list differences between IFRS and US GAAP regarding financial statement presentation. Some of these we discussed during the previous example, but I will run through them all quickly. The first difference is which periods a company is required to present on the face of the financial statements. US GAAP requires 2 years for the balance sheet and 3 for other statements. IFRS requires 2 years for all statements. Next is a difference in balance sheet presentation. US GAAP provides the option to classify as current or non-current and states that accounts should appear in order of decreasing liquidity. IFRS requires a classified balance sheet and states that accounts should appear in order of increasing liquidity. There is also a notable difference for income statement presentation. For US GAAP, expenditures are usually listed by function, whereas in IFRS, expenditures may be listed by function or nature. Finally, under US GAAP, unusual items should be reported on the face of the income statement and disclosed in the footnotes, but under IFRS, only disclosure in the footnotes is required, and reporting on the face of the financial statements is optional. Oh, right. Thanks, Chloe. No, that's not a typo. I'm sorry to say it's a place where our book authors were a little lazy in updating this chapter. Extraordinary items were a difference until 2015, when US GAAP changed the rules to prohibit their recognition, thus bringing the US in line with IFRS. This isn't a major change, though, because it was extremely rare that the FASB would allow something to be accounted for as an extraordinary item. For example, Hurricane Katrina was pretty extraordinary, but the FASB did not allow losses to be reported according to the rules for extraordinary items. There is also a difference in the presentation of the statement of cash flows. While both IFRS and US GAAP allow the option for use of either the direct or indirect method, US GAAP provides much more guidance about what types of transactions fit into each of the 3 categories. That's right, Annabelle. This is another place that the book is a little sloppy. When the previous version of the book was written, they noted that it looked like the deferred tax classification would soon be converged, and that the final standard would be similar to that of the current US GAAP. In fact, what happened is that the standard was converged, but it was the IFRS standard that won out. The old US GAAP standard required deferred tax assets and liabilities to be classified as current or non-current, depending on the classification of the underlying transaction that led to the temporary tax difference. Now, however, all deferred assets and liabilities are considered non-current. This concludes the lecture on IFRS versus US GAAP presentation differences. Please remember to email any questions you might have for our discussion.